What's up YouTube? I'm Casey with bestinvestingapps.com, and today we're going to be talking about how to choose funds for your portfolio. That includes mutual funds and ETFs. Plus, if you stick around, I'm going to be giving away a few free copies of my ebook, Invest. So let's get right into it. Let's start off by briefly reviewing what an ETF is versus a mutual fund. We're not going to go way into the details. We'll just keep it brief here. ETFs tend to be more passive, and they usually follow a market index and therefore have lower expenses. They're basically cheaper to own, and they have pretty straightforward concepts. They're meant to reflect an index benchmark. Mutual funds can really be all over the board. They're actively managed. They have a fund manager who is paid from the expense of the fund. The fund manager runs a team of people that select investments for the mutual fund. Mutual funds can turn over investments daily, weekly, monthly. They can be more active or more passive. Mutual funds tend to span the whole spectrum, and their expense ratios tend to be a little more expensive. Mutual funds also are only bought and sold once per day at the end of the day, and the price that you pay for the mutual fund always equals the value of the mutual fund, whereas ETFs can change value throughout the day and they can be traded more like a stock at any time during the day. The first factor that we're going to talk about when choosing a fund, whether it's an ETF or a mutual fund, is the expense ratio. I like to use Morningstar.com. I'll have a link to that down below. So we'll just come in here, and whatever you're looking for, just type it into the quote bar. In this case, I've already selected PREMX. This is a fund that I own. And we can come and we'll see the expenses right here near the top. This is a little bit different for ETFs. So if I type in VTI, which is one of my favorite ETFs, you'll see that the expenses are still right here in this top bar. They happen to be over on the side. Now, if you noticed, the mutual fund, PREMX, had an expense ratio of nearly 1%, whereas VTI, an ETF, has an expense ratio of about 0.04%. So a huge difference in expense ratios between mutual funds and ETFs. While you normally want to choose the fund with the cheapest expenses, remember that expense ratio is not the only factor. You need to also consider all of the other factors of the fund and decide whether or not the expense ratio makes sense. Another crucial factor, particularly in mutual fund selection, is the fund manager's tenure. If you remember when I talked about expense ratio, I spoke a little bit about the fund manager whose job it is to buy and sell and generally run the fund. They choose what happens with the fund, of course with the input of shareholders. To find out how long the manager has been running the fund, come to Morningstar.com and we'll click on the Management tab after we've typed in the fund that we want. And we can see the fund inception date here, 2005. We can also see that Jerome has been running this fund since its inception date in 2005. So this fund has had the same manager since inception. That tells me that the performance of the fund is likely to reflect what it has been doing in the past, based on the manager's perspective. So if I had logged in here and I see that this fund got a new manager maybe a year or two ago, I could expect that to perhaps throw off some of the returns of the fund, or maybe that manager could disrupt the way that the fund has been running a little bit. Maybe they have a different viewpoint, perspective, a different opinion, whatever. So the longer a fund manager has been with the fund, the more sure a sign that is for you. Now, it doesn't guarantee anything, but it is a good sign. To get a sense of past performance of our funds, we can either use the fund's prospectus or we can use a third-party source. In this case, I'm going to log on to Morningstar. I'm going to type in VTI, which is the Vanguard Total Stock Market Index, and we're going to check its performance over the past few years. If we look here, we can see that VTI is blue, the S&P is green, and VTI has pretty much outperformed the S&P because it's a total market index. And if we look down here, we can see an annual bar chart breakdown. The trailing total returns I tend to go to most often. I look for trailing total returns on the furthest year date possible. So this is an average return right here Over the last 15 years, it's averaged 9.16%, which is awesome, compared to the S&P, which has averaged 8.63%. The longer back you can find data, the better. It gives you a more realistic sense. You might find a 1-year, 2-year, or 3-year return that's crazy high, but you may notice that the longer return is a little more mellow. So you can find all that information in here. When we start looking at mutual funds, the same can be done. So we'll look up a mutual fund here. We're going to click on the performance tab. We'll wait for it to load up here. So we can see as far back as we have data. So PAR WX only has data back 10 years. 10 years is pretty good. 12.46% averaged over 10 years is not bad. If you find a fund that doesn't have data back any more than 3 to 5 years, I wouldn't buy into it based on those returns, because 3 to 5 years is hard to judge the returns of the fund. And of course, as always, the past performance could change in the future, but usually the longer you have a history of the fund and its performance, the better judgment you can make as to whether or not that fund belongs in your portfolio. Now we're going to talk about something that's a little less quantifiable, a little more subjective. We need to know what each of these funds is trying to accomplish in order to make a good judgment. So we're going to log on to Morningstar, click on the Filings tab. I'm looking up Parnassus Endeavor Fund. I'm going to click on the Summary Prospectus here. You can open the full prospectus, and I encourage you to do so before you make a choice, but the Summary Prospectus is good enough to help us start to narrow down our choices here. One of the things that we want to look for here is the principal investment strategies. So this column will be included in every prospectus. Each prospectus for any mutual fund or ETF by law must include its strategies. So you want to read through that in detail. That's going to tell you how the fund attempts to achieve the things that it does. Does it use leverage? What does it trade in? How much of each different type of stock can it own? All of those different things will be in here in detail. And then a little bit further down, again, principal risks is always included. These are not necessarily all of the risks of investing in each fund, and a lot of funds will share many of the same risks, but you'll find a list of all of the risks and any risks that are specific to this fund under these principal risks column. Make sure you read through that and understand it. If you were to invest in a leverage fund or an inverse fund, they would declare all of those different risks, and you might find something in there that you didn't expect, and you're like, oh my gosh, what is this risk? I don't understand it. Well, go Google it. Just type in the name of the risk. All these different types of risks are pretty standardized, and you can find good descriptions of any of them. If you don't understand it, it doesn't make sense, it's probably not good for you to invest in. We also need to check the industries and sectors of each fund that we're investing in. Even though ETFs and mutual funds hold maybe hundreds of underlying investments, sometimes if we're not careful, those investments can overlap. So one mutual fund might own a bunch of Apple shares. I could buy another mutual fund thinking that it's different or diversified, and it could turn out that that fund also owns a bunch of Apple and Microsoft. And then I've kind of doubled up on my exposure to a single stock or a single market sector. So we'll come into Morningstar, and we're going to click on the Portfolio tab. You'll be able to find all sorts of good information. If you want all the details on this, go over to the link below. It'll take you to the full article on best investing apps. You can get the details. But basically what we want to look at are the sector weightings, the regional weightings. So you can see here that this fund is mostly invested in North America. And we might even want to check the largest holdings of each fund. So if I see that one fund owns 5 or 10%, which would be unlikely, that's very high, but they own a lot of a certain stock, and I find another fund that owns a lot of that same certain stock, might want to watch out for that. So just make sure that you're staying diversified as much as you think that you are by checking your funds, sectors, industries, and holdings. Finally, we're going to talk a little bit about expense ratios, commissions, and sales loads. So if we are trading or buying or selling mutual funds, we could be hit with a sales load, which is basically a fee up front to buy that mutual fund. We can look for mutual funds that are no load or no transaction fee, and I have a list here from E-Trade called their All-Star Mutual Funds list, which I'll share with you in the link below. These are all really good performing mutual funds that do not have a sales load, so they're no transaction fee, no load funds. Means you can buy them without paying a huge chunk. They still have expense ratios, and ETFs also share that expense ratio. So every year, the fund will charge you a certain amount of the assets that you hold there. So if I hold $1,000 in a fund with a 1% expense ratio, it's going to charge me 1% of that $1,000, which I think is $10 every year. Now that's on top of any commissions. So ETFs are probably going to charge you commissions. Commissions are different for each brokerage. So if you use E-Trade or Trade King or Charles Schwab, your commissions will be different. You'll have to look those up. They'll depend on your brokerage. I can't tell you what they are. You got to figure them out yourself. Remember, you can check the list below and find these all-star mutual funds. I'll share this list with you. If you want to get ETFs without paying a commission on them, I really highly recommend M1 Finance. M1 Finance will allow you to buy and sell those without a commission, which is really, really, really nice. It's one of the big reasons why I use it myself. If you managed to follow me this far through the video, you should be pretty well off to start choosing ETFs and mutual funds for your portfolio. Remember, there are several things that we didn't talk about in this video. The world of investing is almost infinitely deep. There's always more to learn. However, these are the basics, and you should be able to get started quite safely and effectively using what we've talked about here today. I know I promised to give away some copies of my free ebook. You'll find the link to that down in the description below, as well as the full article about how to choose your own funds over on bestinvestingapps.com. I want to have a shout out to everyone who's subscribed to the channel. We're coming up on 100 subscribers, which is pretty wonderful. So thanks everybody, and we'll see you next time.